we have compounded in the space of 4 months at around 10%. That's raw return, significantly ahead of the benchmark. And what we'll try to do this afternoon is give you some insights as to why does Rising Giants compound so well. What is the, we've historically spoken about the secret sauce of CCP, the secret sauce of Little Champs. This afternoon, we'll reveal to you why Rising Giants compound so well. I'll lay out the broad intuition, the broad hypothesis behind the fund. Ashvin will then show you how the fund is constructed. And as ever with Marcellus, we will keep empty talk about macroeconomics to a minimum. We'll actually give you details of the stocks inside the fund. Right?
So good evening, ladies and gentlemen. I am Sankalpo representing PMS AIF World. We have a very special guest, the entire team of Marcellus Investment Managers with us today. Let me introduce to the audience today. We're going to talk about the new portfolio Rising Giants. And we are calling this webinar, why, the entire idea of this webinar is to understand from them why do they call it the Rising Giants. From time to time, we will keep taking questions from the audience and we'll try to answer as much as we can. But before that, we will begin with the presentation that the team at Marcellus has prepared for us. And, I'll just upload, the presentation so that Ashvin and Saurabh can begin with their discussion today. So over to you guys. Just a couple of minutes before the presentation is uploaded. Saurabh, I'd like you to take the floor and start the context.
Sure. So thanks, Sankalpo. Thank you, folks. Thanks for joining us this evening. So as many of you know, Marcellus started live 3 years and 2 months ago. I think it was 2nd December 2018 that we opened our doors to new clients. And we've reached a juncture where we now look after 12,000 crores of your money. As again, many of you, I suspect, know, and Sankalpo very generously mentioned, consistent compounders is the flagship product. That's what we started on 1st December 2018, and 3 years and 2 months in, consistent compounders is still gunning out 27% compounded, a good 10 percentage points faster than the Indian index, with significantly lower volatility than the Indian index. So not only does consistent compounders give you outstanding returns in terms of superior performance, but the volatility is significantly lower. Buoyed by the success of consistent compounders, in August 2019, we launched Little Champs, a fund which Ashvin manages. Little Champs does exactly what consistent compounders does, but whereas CCP focuses on large companies, a typical CCP stock is 1,60,000, 1,70,000 crores in market cap. In contrast, a Little Champ stock, an LCP stock, is all of 3,000, 4,000 crores in market cap, right? So dominant franchises, CCP, large and mid cap dominant franchises, Little Champs, small cap dominant franchises, and Little Champs has gone on to deliver stellar returns. I think it's compounded. The fund that Ashvin is running is compounding at around 45% from inception in August 2019 to Jan 2022. Now the only challenge with Little Champs is the liquidity in these stocks is modest, right? Because the market cap is all of 3, 4, 5,000 crores. The free float on these stocks is sometimes as little as a few hundred crores. And because money came in, several of you invested very promptly in Little Champs. Money came in very quickly in Little Champs. As early as June 2020, we had to stop taking money in Little Champs. So in June 2020, Pramod and the sales team told customers that we couldn't take further inflows into Little Champs. And obviously, thousands of you were disappointed that such a high quality product, we couldn't accommodate you. We believe us, we would love to do so, but it's just that the liquidity isn't there in those small cap stocks. So urged by the sales team, we started working on a mid cap, a small and mid cap product, right? CCP is large cap, LCP is small cap. So urged by the sales team, we started working on a product in between these two extremities. And I'm sure you'll be delighted to know that on 16th August 2021, with Ashvin as the fund manager, we launched Rising Giants. Rising Giants focuses on small and mid cap stocks, whereas a typical Little Champ stock is all of $500 million in market cap. A typical Rising Giant stock is more like $3.5 billion in market cap, right? And with Ashvin at the helm, back in the launch on 16th August, So far, we have compounded in the space of 4 months at around 10%. That's raw return, significantly ahead of the benchmark. And what we'll try to do this afternoon is give you some insights as to why does Rising Giants compound so well. What is the, we've historically spoken about the secret sauce of CCP, the secret sauce of Little Champs. This afternoon, we'll reveal to you why Rising Giants compound so well. I'll lay out the broad intuition, the broad hypothesis behind the fund. Ashwin will then show you how the fund is constructed. And as ever with Marcellus, we will keep empty talk about macroeconomics to a minimum. We'll actually give you details of the stocks inside the fund. Right? Sankalpo, are we in a position to use the slides? Ashwin,
Right. So, Saurabh and Ashwin, before we head on to the presentation, let me just lay the broad context of webinars at PMS AIF World. For the first 20-25 minutes, you can go ahead with the presentation, and then post that we will try to take questions from the audience. And I know, Saurabh, you enjoy taking questions from the audience. That is why we kept some good time there. So over to you. I'll start the presentation. Welcome, ladies and gentlemen.
Thank you very much. So I think we can toggle. So this is, let me just try to toggle forward. Here we go. If we do next. Yeah. So if you look at this slide, right, this slide in a way captures the driving force behind all our funds. The reason all of Marcellus's products have gone down well in excess of 25% over the last 3 years is in a way captured by this picture. What's happened in India over the last decade or so is the country has got joined up. The country has got networked in 3 specific ways, and these three joining up, these 3 measures that have been taken to change the country have been very powerful. And if you ask me, right, the central insight which underpins all of our products is this joining up. So step 1, if you look around you, you'll see that the highway network has doubled in the last decade. The number of broadband users is up 50-fold. The number of local airplane travelers is up 5-fold in a decade. The number of bank accounts has trebled in a decade. In addition, you have GST, you have UPI, right? So when you join up a country as big as ours, when you take 20 small economies, that's what India was a decade back. We were 20 small economies. When you integrate them, you basically crush the local player, the regional player. You create national market leaders. So at the simplest level, the local Gujarati jewelers near my house in Powai are gradually winding up because the local Tanishq and the local Carrot Lane, which is a Titan subsidiary, they are garnering market share, right? The Punjabi jewelers I went to school with in Delhi, they are gradually winding up. Again, Tanishq and Titan are cleaning up. It's not really feasible for a local jeweler to compete with Titan, whether it's on cost of capital, whether it's on talent, whether it is on design, whether it is on quality. It simply doesn't stack up. Titan, therefore, has grown 200-fold in the last 20 years, whilst the local jeweler shrinks away, right? So that's the first layer of change in the country. The second layer of change, we in India have been super lucky. Over the last 10 years, the rise of low-cost world-class technology, which is mobile, SaaS, and cloud. Mobile, SaaS, and cloud has been a massive boon for well-run small businesses who can use this low-cost world-class technology to scale at a cost and at a speed which was not conceivable even 10 years back. We just take our own business, for example. We have 10,000 folks like you as clients. Out of those 10,000 people, some like 3,000 clients come from places, towns, cities that we have never visited, right? And in spite of us never visiting those places, courtesy webinars like this, courtesy YouTube, courtesy Amazon, courtesy Salesforce, the sales team that Pramod runs, there's 10 people in Marcellus using Salesforce, using analytics to cater to our 10,000 clients. Now, Bajaj Finance is the largest user of Salesforce in the country. They'll have something like 2,000 licenses. We are a small user of Salesforce, but like Bajaj Finance, we get access to the world's best CRM platform. A decade ago, that would not have been possible. A decade ago, you would have had to hire a systems integrator, pay them 50, 60 crores, pay for a server installation. I would have probably been bankrupted by that whole expense, right? Now, smart, small companies, not just us, we'll discuss several portfolio stocks, are using SAP, using Salesforce, using SaaS, using mobile, and growing at a pace that was not imaginable even 10 years ago. That's the second change. The third change, which we have deliberately not put on the slide, is the attack on black money. Right? There's obviously a political dimension to it. We won't get into it for understandable reasons. But the attack on black money does two very powerful things for you and me. Firstly, the attack on black money hammers the competition to our investee companies. To take, for example, just sticking to the Titan example, the local jeweler, whether it was Bombay or in Chennai or in Delhi, a big part of the local jeweler's profitability came from tax evasion, and a big part of his profitability came from laundering black money. With the attack on black money, both of those have become much harder to do. It's become harder for the local jeweler to evade taxes and launder black money. Thus, the local jeweler is relatively at a disadvantage now to a Titan. And second dimension, as the attack on black money has accelerated, the attack on whether it's black money laundered through real estate or black money laundered through gold has accelerated, it's become less and less relevant, less and less attractive for Indian households to put money in real estate and gold, right? And as that has happened, money has flown into the financial system. The cost of capital has come down. So,
Saurabh, I think we lost your voice there. Can you hear us, Saurabh? Okay, no problem. So Ashvin, if you want, you can take over from here, and we can wait a couple of minutes for Saurabh to join in again.
Yeah, so I think Saurabh was pointing towards, there has been quite a drastic change in the Indian economy towards formalization in the last decade or so, be it through the improved connectivity in roads, physical infrastructure, be it the improved connectivity to digital internet. Similarly, what we saw around 5 years back, kind of assault on the black economy through either GST or demonetization. Similarly, Saurabh, you want to?
Sorry guys, sorry, my broadband is pretty iffy. It's the local broadband supply. I'm really sorry about this. So 3 sets of changes have transformed the country, and now we'll show you the impact on our portfolio stocks, and we'll now contextualize rising giants. So let me go forward one slide, right? So we've shown here on this slide a bunch of our stocks from various portfolios, right? So just sort of set the context of the slide. The left-hand panel is free cash flow growth. Free cash flow is what a company is left with once working capital and capex has been taken into account for, right? Profits is not the best way to measure a company. Free cash flow takes account of capital expenditure. Free cash flow also takes into account working capital strains. So free cash flow is the surplus left over with the company at the end of the year. Left panel is free cash flow. Right panel is share price growth, right? We've shown you 20 years free cash flow growth, last 10 years, the 10 years prior, the latest 5 years, and as you would expect, a typical Marcellus investee company, regardless of our portfolios, roughly grows free cash flows at 25%, which means 10x in 10 years growth in free cash flows and 100x in 20 years, right? So that's the left panel. The right panel is showing you that share price compounding is, no surprises, share price compounding is same as free cash flow growth, right? Share price compounding is neither driven by the Federal Reserve, nor driven by GDP growth, nor driven by election results, nor driven by PE multiples. Share price compounding is driven by free cash flow compounding, right? And share price compounding has been also, as many of you I'm sure know by now, 25% last 20 years, last 10 years, the 10 years prior to that, the last 5 years, the 5 years prior to that. That's pretty standard market stuff. But now cast your eyes on the rows of this table. The upper part of the table are stocks that were prominent companies even 20 years ago. So 20 years ago, had you and I been speaking, an Asian Paints was already a market leader, a Nestle, a Pidilite was already a market leader. And therefore, if you see their free cash flow compounding in the last 20 years, if you come to the 20-year free cash flow compounding column, you'll see they've grown free cash flows at around 25% in the last 20 years, which is a tremendous feat. 10x in 10 years, 100x in 20 years. That's a lot to laud an Asian Paints or a Pidilite for, right? But if you focus on the lower part of the table, and this is where the reason I'm taking you to names like Tej, Relaxo, Dr. Lalis, This is where Rising Giants focuses. Companies 3, 4, $5 billion in market cap. You will notice that these companies haven't grown free cash flows at 25%. They've grown free cash flows more at 35%. And see the FY 11 to 21 column, you'll see 36% Page, Relaxo 59, Dr. Lal 35. Right? These are tremendous numbers, which means in 10 years, these companies have grown not tenfold, they've grown more like 20, 25-fold. How have they done that? Right? The answer lies in the change that the country is going through. Page, Relaxo, and Dr. Lal were barely existent 20 years ago. These companies are creatures of the new India, an integrated India, a technologically driven India. Right? Just to take an example, if you see Dr. Lal PathLabs, a decade or so back, 2010 till 2010, the promoter, the founder, Dr. Lal himself ran it. It was a successful but small operation in Delhi, around 20%, 25% return on capital, 40, 50 outlets, basic blood test, urine test type setup. Om Manchanda, ex-IIM Ahmedabad, ex-Unilever took charge. In the space of 10, 11 years, Om has transformed Dr. Lal into a powerhouse with honestly no comparison in the path lab industry. A company that 10 years ago had 25% ROC today has 125% return on invested capital. Dr. Lal is a money machine with no equal in the path lab industry, significantly larger than any competitor and by far the largest organized player. Now, how did Om pull this off? Three layers of technology have been central to Dr. Lal's rapid success. Firstly, very early on, Om realized that why just focus on Delhi? Let's expand the franchise to UP, Jharkhand, Bihar, Bengal, Madhya Pradesh, Northern Maharashtra. But let's not do that in a haphazard fashion. Let's use technology. So early on, they built a basic technology platform which told them for any district or any city, population density in an area, retail footfalls in an area, and competitors' geolocation. By using this piece of software, they located their path labs, their testing centers in spaces where comparative intensity was low, population density was high. Right now, basic insight, but hey, nobody else had it, and even if others had it, others didn't operationalize it. Om Manchanda did. Focus on building out where population density is high, comparative intensity is low, and a company which had 40, 50 testing centers a decade ago today has 5,000, 5,500 testing centers, by far the most in the country. Right? Second layer of insight. He said that look, as people like Saurabh get older, richer, and sicker, they will not just need blood tests and urine tests, they will need far more advanced tests. So Dr. Lal rolled out layer after layer of value-added products related to genomics, related to allergies, executive health checkup, oncology, and so on. Today, they offer 5,000 tests. The nearest competitor offers 3,500. Right? These extra tests that Dr. Lal offers are high margin tests. We reckon operating margins of these high value tests are pushing towards 30%. No other path lab offers this. Whether you live in Delhi or Bombay, you'll see that Apollo Hospitals outsources many of its highest end tests to Dr. Lal. Now, this creates a challenge as well. It's simple for me to sit here and say they offer high margin tests. It creates a massive inventory management problem. To offer a typical test, you need 4 or 5 items of inventory, right? Syringes, plastic containers, reagents, and so on, right? So if you're offering 5,000 tests, you need 25,000 items of inventory across thousands of testing centers, right? So how does Dr. Lal manage it? So just think about the path lab industry for a minute. Receivable days are zero, right? Receivable days means they get paid instantaneously. So when you do your COVID test, you pay Turant, and therefore there's no receivable days. But in a path lab industry, for the reasons I mentioned, inventory days become very high. What Dr. Lal did is remarkable. 2013, they bought an SAP, and they put in place by 2014 a way to use SAP in a certain way. So in their control center in Gurgaon, they will sit and monitor. For example, they'll monitor how many days of urine test ka containers do we need. So in Kurukshetra, we might need 6 days of supply. In Meerut, we might need 11 days. Across the entire Dr. Lal operation in northern India, we might need 12 days of urine test ka supply. And then their team, the procurement team, will cut a deal with the supplier, which will say, give me 12 days of credit, and I'll give you the order. That way, the supplier's creditor days offsets Dr. Lal's inventory days, and this giant company operates on a zero working capital cycle. Right? The only path lab in India to operate on a zero working capital cycle. Right? The same technology available to everybody, Dr. Lal uses it more cleverly than anybody else. And the final piece, right, the rise of this little thing, So 3 years ago, Om Manchanda told me that our challenges are very similar to a restaurant. And he explained that just as a restaurant owner is never happy because either the restaurant is partially empty or it's so filled up, it's turning patrons away. A path lab has a similar challenge. And the only way to mitigate this, he says, is to move the business towards a home collection model. Right? And over the last couple of years, obviously aided by COVID and obviously aided by this little thing, they've pushed the business mercilessly towards home collections. What is the big benefit of home collections? In the pre-home collections world, path labs tend to have peaks in the morning and in the evening, and for much of the day, the infrastructure is running on a slack, on a redundancy. Right? That obviously creates asset turns. That creates asset turns which are suboptimal. Right? You're not sweating your infrastructure anymore. By pushing the business aggressively towards home collections and mobile, they're improving the way they sweat their assets. So if you look at this business, operating margins have improved in the last 10 years. Asset turns, i.e., how much they sweat their assets, has improved 40%, I think, in the last 5 years. Working capital cycle has gone from 25 days to zero. And the result is you have a 125% cash generation machine. And how is Om using that cash? Those of you who live in Bombay, you've seen how he's using that cash, right? He came to your and my neighborhood and he acquired the second largest cath lab in Bombay. So the way the Dr. Lal team works is there's a group of people who rove around the country looking for regional operations which are credible. They sit down with the regional player and say, look, you have a choice in life. You can compete with us and you know what's going to happen to you. Or on that table, let's say 10 crores of cash. Why don't you take that? Become part of our operation, right? You will run the business. Your brand name will be retained, but you will be part of the Dr. Lal family and our super efficient backend will kick into your business. And thus, this company is consolidating the path lab industry. 85% of the path lab industry is mom and pop path labs. 85% is mom and pop path labs. 15% is national chains. Dr. Lal is India's largest national chain, the most cash generative national chain. And by joining us in the Rising Giants journey, you help us consolidate, you help Dr. Lal consolidate the path lab industry. And along the way, we compound at a very healthy rate. That is the fundamental insight which drives the Rising Giants portfolio. Let's invest in companies $1, 2, 3, 4, $5 billion market cap, companies which are clean, efficient, dominant, and with their dominance, they're consolidating giant industries and creating epic wealth for you and me. Now, how exactly do we construct this portfolio? How have we compounded so far? I'll request my colleague Ashvin Shetty to take you through that.
Yeah, thanks, Saurabh. So I will move to the I think investment process slide itself. So as Saurabh said, basically we are looking at companies. Basically three criteria. One is the company should be clean, because no matter how strong the company is, but if they are not minority friendly, we as minority shareholders will not generate any return from that company. So the first requirement, it should be a clean company. Second is it should be dominant company. The higher the dominance of the company, the higher the free cash flow generating ability of the company. And finally, the company should be smart capital allocators. It shouldn't be too lazy that the cash is just getting accumulated on the balance sheet. At the same time, the company shouldn't be super aggressive that they are investing into all and sundry businesses where the chances of making return is close to zero. So we want very smart capital allocators, just like Saurabh gave the example of Dr. PathLabs. Either reinvest back into the business, technology, etc., or basically expand geographically. Just like Dr. Lal bought Suburban Diagnostics and got a footprint into West India. So to find that elusive list of companies, so we have the investment process as shown in the slide. So basically, there are two broad process to our investment. There are two broad parts to our investment process. So one, we use our quantitative screens to narrow down the opening universe to a researchable list. And basically on that researchable shortlist, we do our bottom-up research to arrive at a final 15 to 20 investable companies in the portfolio. So for this portfolio, as Saurabh said, we are looking at a market cap of $0.5 to $10 billion market cap. So there are 450 listed companies. So the first quant screen which we employ is the forensic accounting screen. So this is nothing but a set of 12 accounting ratios which we use to rank company on their accounting quality, basically deriving comfort about the reported numbers, whether they represent a true and fair view of the underlying businesses. So this is the first stage. 12 accounting ratios लो last 6 years का financials ले लो, उसको rank करो companies को on 12 ratios. And here we eliminate the bottom 40%. So we have a decile based ranking D1 to D10, and we eliminate companies which come in the bottom 40%, D7 to D10, because our model says that the reported numbers of these companies cannot be relied upon. So this is the first check. 40% companies get eliminated. Now we are left with 200 to 50 companies. So our objective is to find companies which are generating healthy ROC well above the cost of capital. They are investing a lot of capital back into the business, and at the same time they are also able to sustain the ROC on the incremental capital employed. So to find those companies, so again on 6 years financials, we have 4 metrics which we use. So we rank these 200 to 50 companies on what is the growth in revenues over the last 6 years, what is the improvement in operating margin over the last 6 years, what is the improvement in working capital days and fixed assets turnover over the last 6 years. And we select companies which score more than 50% on each of these individual ratios. So for example, if a company scores very well on revenue growth, but it has faltered on the working capital days, that company wouldn't get selected. So company has to beat a 50% threshold on each of these 4 ratios. And very small set of companies actually make it pass through this screen. So only out of these 200 to 50 companies, 35 to 40 companies make it pass through this capital allocation screen. And this 35-40 companies forms the basis for our research. So here on the bottom of research, we do 2 things. One is we read at least 15-20 years of the annual report of each of these companies. We believe reading 15-20 years of annual reports will help us build picture on the evolution of the company, identify in the past how did the promoters management behave during crisis. That gives us a very good conviction level of the capability and the mental makeup of the promoters. At the same time, we also do a lot of primary data research. So typically we like to meet and speak to at least 10 to 15 people in the industry who can give us insights on the company. So typically either the competitors, vendors, ex-employees, and so on. And this takes a lot of time. So typically in a small and mid-cap company, it takes anywhere between at least 6 months to at least 2 years to get and meet and speak to 10 to 15 people in the industry. But we think that is worth doing that, investing that time for the insights that we get on to this company. And finally, after doing both the secondary and the primary data research, we use our position sizing framework to decide which of these 35, 40 may say, कौन सा 15 companies will make it to our portfolio. So I'll briefly cover this. So basically, the gist of this slide is that while we focus on here and now, what is the current mode of the company, what would be the EPS growth over the 3 to 5 years, we also try to build conviction that it is a 15, 20, 25-year story, not a 5-year story. Because just to give you an example, if a company is generating EPS growth of 20% for the 5 years, and then that company fades in, kind of the growth starts fading down, uska justified PE multiple under the DCF model shouldn't be more than 20 times. But if that company is able to sustain the earnings growth of 20% for say 15 years, the justified multiple for that company can be almost 100x. And if the company is able to sustain the earnings growth for 25 years, the multiples can be even north of 250 times. So it's very important to convince. It's not just a 5-year story. So to do that, we look at 3 parameters. One is the moat scores. Moat, as I said, like it's more about the here and now. The one simple test which we use is that the pricing power of the company. If tomorrow a competitor comes in the industry and introduces a product, say 15-20% cheaper than the company, will the market share or the return of the company come down? If the answer to that is no, it means that the company's moat is very strong. It can endure. Basically, the pricing power of the company is very strong. But at the same time, we want management which are not complacent. Just because the company has a moat, it shouldn't make the management complacent. The management should always be thinking ahead of the curve and try to deepen its moat. Saurabh gave an example of Dr. Lal PathLabs. So it went into investing into these mobile apps and so on. So we look at that aspect: is the company getting complacent, or it is agile and always remains ahead of the curve. Similarly, we want companies which always think about adding new growth drivers. While these new growth drivers may be adding very insignificant currently, but company should be thinking, say, 10 years down the line, whether the current industry or the addressable market is sufficient to sustain growth for beyond 10 years. If it is not, the company should start thinking about adding new growth drivers, and that can take the form of either new products, get into product adjacencies, or basically expand geographically. But there should be at least a thought, and there should be some process started with respect to adding new growth drivers. And finally, we look at whether the company is anticipating, what could be the disruption. Again, nothing, could not be any threat in the near term, but is there any disruption that could happen in the industry in the next, say, decade or so? Companies, because we have seen not only in India but globally, many of the so-called big companies, Hitarco, they have got technologically disrupted because they were always complacent about these things. They never anticipated this change could take place. So we look at that aspect. So that was on the lethargy score. And finally, on the succession score, we look at succession part. We look at whether the company is also scaling up on the talent side. The company, is it, and this is very relevant for the small and mid cap companies, where the promoters are very reluctant to go off their let off their power and responsibility. So we look at whether the company is also scaling up on the talent, whether the company is building a team. What is the constitution of such team, whether it is largely the friends and families, relatives of the promoters, or it's a professional talent is brought on the board. What is the incentivization of the management? And finally, we also look at the board quality, independent board, particularly the independent board, whether they are of such credentials, experience that they can stand up to promoters and question their capital allocation and strategic decision, or largely they are the yes men. We look at that aspect. And after doing work on these aspects, moat, lethargy, and succession, we rank the companies. So, and the best 15 companies, they make it to a live portfolio. And coming to the actual portfolio, uh, this is how the portfolio looks. So currently we have 15 stocks in the portfolio. The names of 5 stocks are disclosed on the slide. So I think the third, fifth, and sixth columns are very important. So the third column is EPS growth. You look at the overall weighted average portfolio EPS growth of the portfolio. It is close to 21%, and this 21% is in the context of the kind of the macro slowdown or the disruptions that we have seen in the last 5 years. Despite one of the unprecedented macro slowdown and disruptions, either it is GST, demonetization, or even pandemic, these companies have been able to deliver very healthy earnings growth. And that has come largely because either these companies have grown market share within their sector, or they have made very well use of their capital allocation to get into new products or new geographies. So in other words, these companies have not dependent on the macro benevolence. They have taken the destiny in their own hand, and they have actually generated the earnings growth. And the fifth column is also important. Despite these companies reinvesting back a lot of cash into their business, the free cash flow compounding is even better at 24-25%. It's even better than EPS growth. And this has again come from two things broadly. One is that as these companies have gained share in their respective sectors, their position has improved vis-a-vis both their customers as well as their vendors. As the result, they are able to extract better credit terms from the vendors, give lower credit terms to their debtors, to their customers. And secondly, these companies have invested a lot into technology, particularly in the back end. As a result, they are able to better anticipate for example, the inventory requirement, what should be the production level, and they have been able to bring down their working capital. And finally, if you see the last column also is very important, you'll find that most of the companies, the debt equity ratio is in bracket. That denotes that most of these companies have surplus cash on their balance sheet. And in today's environment, cash is the king, and this places them in a very strong position to further consolidate market share, either organically or inorganically. In fact, for most of the company, we have seen that already they are actually acquiring the weaker players in their sector. So Saurabh gave the example of Dr. PathLabs. Similarly, in GMF Folder, for instance, Last year, they acquired the third largest company called Dietrich Process Systems in their glass-line equipment business. So this strong balance sheet places them in a very advantageous situation to further consolidate and gain market share in their respective sector. And as a result, we remain very, very sanguine and very confident about the prospects, the earnings growth, the free cash flow prospect for these companies for the next even 3 to 5 years. I think we will stop here. I think we're running a bit of short of time.
Right. Thank you, Ashwin. Thank you, Saurabh, for that presentation. And I think the Lal PathLabs story was really exciting. We've got a lot of questions. Okay, Saurabh, I think the question bar is also visible to you. So if I miss out something, or Pramod and Ashwin, if I miss out something, please feel free to choose an answer as well. The first question that I will begin with is from Ms. Rashi Jhunjhunwala. So she's asked somewhere, what is conventional wisdom is after a while there's a peak growth period where companies grow at super crazy rates of growth, but then what we've read in textbooks, what we've seen, they might tend to slow down. Okay, and a lot of companies these days are increasingly using technology, trying to get good talent from top B schools or top colleges. What is it that you have understood that these CCP or rising giants kind of company, how do they interact with this top talent or technology that that helps them grow at superlative rates for a very, very long period of time?
I think we've discussed this, in hundreds of webinars, and I would refer the person who's asking the question also to our two books, which are easily available: The Unusual Billionaires and the more recent book, Diamonds in the Dust. The answer, in a nutshell, is in a country like India, which is still very poor, right? We are amongst the poorest countries in the world at $2,000 per capita income. We are so poor that even if we grow at 8% for the next decade, which I think is a reasonable trajectory for India, 8% real GDP growth, I think anybody on this call will feel pretty happy about. Even if we grow at 8% GDP per capita, 8% real GDP growth every year for the next decade, we'll still be poorer than Sri Lanka. If we grow at 8% for the next 20 years, we'll be poorer than Thailand. We're that poor a country. Now, in a country this poor, what you get is, if you join the country up, as I was saying at the beginning of the presentation, when you join the country up, you kill the local player, the regional player, right? And in industries like PathLabs, like footwear, like a whole host of FMCG products, like building materials, like financial services, in these industries where 40, 50, 60, 70% of the industry is in the hands of the informal player and the mom and pop player, if the country is growing at 10%, then the formal sector can very easily grow at 15%. So just take PathLabs as an example. PathLabs is roughly a $10 billion market. Only $1.5 billion is in the formal sector, in the organized, branch-based, organized national chains, right? Dr. Lal, Metropolis, somebody suggested Vijay, etc. So these chains form only 15% of the $10 billion market. Right? $8.5 billion is the local compounder, the local mom and pop path lab. The sector is growing at 10%. The organized part, the national chains, can very easily grow top line at 15%. Because the informal part, the 85%, which is the branch, the chota compounder-led path labs, they're going to shut down. They're going to shut down because they don't have access to modern technology. And anybody who's on this call, feel free to go and check out your local compounder wala path lab. You'll see he or she doesn't have access to modern technology. They aren't able to get talent from the medical schools, the phlebotomists. They aren't able to bring in IIT, IIM talent to run their businesses. And as a result, as the 85%, the mom and pop path lab shuts down, the 15%, which are the organized players, will very easily be able to grow top line at 15%. As we have shown in presentation after presentation, companies that can grow for top line at 15%, if they are reasonably efficient, can grow profits at 20% quite consistently for 10, 20, 30 years, right? We've written lots of books about it for the lady who's asking the question. We've written books about it. We've talked about it endlessly. If you can grow top line at 15%, you can grow profits at 20%. And then by reducing your working capital cycle, by crushing your working capital cycle, by improving your fixed asset turnover, you grow free cash flows at 25%. That means 10x in 10 years. 100x in 20 years, 1000x in 30 years. So the stuff that most people read, the reason we write books for India, folks, is most of you read foreign books on investing. Most of us when we go to business school or when we do courses like CFA, our curriculum is foreign books. The foreign books apply very nicely to America. Our country, unfortunately or fortunately, is very different. We're a poorer country, and therefore we are able to identify high quality companies, 3, 4, 5, 6, 7, $8 billion market cap, and compound our wealth 10x in 10 years, 100x in 20 years. So that's what we have done for 4 years. And if you don't believe what we are telling you, read the books. You will get the last 30 years of data, and then it's up to you to make up your mind, really.
Sure.
I'll add a little bit of emphasis here, Sankalp. I think the growth opportunity for a country as a whole sort of clearly articulated. I don't think we need to fret over whether India offers that opportunity. If you disagree with that, then we have bigger challenges in the country in terms of supporting the billions of people who will come into the workforce. So let's assume with the fact that our politicians will do the right thing. They have been doing the right thing. India will progress at whatever pace it has. The real question to ask as investors is not so much whether there are growth prospects in any industry. The real question to ask is the company that you're going to invest will actually participate in that growth, because the flip side of this sort of structural growth is competition is a given, right? If India is going to be the only large economy with these sort of growth prospects, competition will come from all over the place, whether it's Reliance Jio or Amazon or a Blackstone funded or a VC funded. Everybody wants to participate in that growth. So the real question you need to ask as an investor is whether the company you're considering to invest has something unique, has something which is differentiated, which such new competitors will find it difficult to replicate. Often you get carried away with growth. There'll be plenty of industries which has supernormal growth prospect, but you may not make any money from there because there are no entry barriers in that. Several new competitors will come and compete away the returns from that industry. So rather than obsessing about growth in a poor country like India, you need to obsess even more about competitive advantages and entry barriers, which is what tends to be the crux of any Marcellus presentation or webinar, if you've been following us. So just a little bit of emphasis, not so much on growth is necessary, but not sufficient. What's more important is differentiators and competitive advantages.
Right. Thank you, Pramod, and thank you, Saurabh. So while you were answering that, I've got a very interesting question on my WhatsApp. So one of our clients asked us, given the opportunity size of India across industries, you seem to like to have concentrated bets and concentrated portfolios. Is that choice that cannot be because of a lack of opportunities, right? So what is the reason? I understand with CCP you are trying to focus on the profit pools. With a portfolio like Rising Giants, again the number is around 15, 16. Any thoughts on that?
So look, I think one point that I think a lot of people, the older people in this call, I'm sure have realized, the Indian opportunity has been available for the last decade. You could argue 2 decades for lots of companies, but companies that have been able to turn that Indian opportunity into hefty profits are few and far between. Right? And there are 3 reasons for that. And we've discussed this before. We'll discuss it probably till the day we retire. Firstly, we have a lot of corruption in our country. It's a big part of the promoter ecosystem does naughty things with your money. So you guys will watch, say TV shows, or you'll be deluded by brokers to invest into those companies. A lot of these promoters will take your money and run away to faraway countries and build their lifestyle. So first challenge is for you and for me. Whilst the growth opportunity is there, a lot of the promoters you and I will encounter are naughty people. They will take our money and run. The second is, even amongst the promoters who are clean, many of them simply don't have the business acumen, the intelligence to actually build a business over 10, 20 years to capture the opportunity. They're good people, they're trying their best in life, but they simply haven't been able to get it together. And that's true for every walk of life. So I'm sure all of us went to school and college and saw plenty of our schoolmates trying their best, but they simply didn't have it in them to excel, right? And therefore, you're left with a very small minority of promoters who are not just clean, who are not just competent. They can combine cleanliness, integrity, and competence and build a business which actually makes a lot of money for an extended period of time, right? So in this entire Indian stock market with 5,000 companies, in our 13 years of work in this country, we've been able to identify all of 35 such companies. And those 35 companies are Marcellus's portfolio. So there are many industries, real estate, for instance, power and infrastructure, for instance, metals and mining, for instance, where haven't been able to identify a single company that allows us to make money consistently. So just because the country has opportunity doesn't mean that on the street out there, $1,000, 1,000 rupee notes are being scattered for you and me. We still have to work hard to identify clean promoters, sensible, hardworking people who will put in 10, 20 years of their lives to build you and me a fortune.
Right. So as long as the criteria are not met, your portfolio will not see them anytime soon, is what the sense is, and that is why the concentration. Am I right?
That's right, Sankalpo, and I think let's engage for a minute in the contrary thought.
Right.
Your clients will give us money. We will go and invest it with crooked promoters. I don't think anybody on this call will want that, right? In fact, a lot of people do that. They go and invest in tracker funds. And if you invest in a tracker fund, you're giving away the majority of your money to naughty people, right? So first thing, I don't think any of us will willingly want to invest with naughty promoters. Now let's take corruption off the table. Even if the promoter is not naughty, he's a good guy. Would you really want to invest with him or her if he's incompetent? Right? If he doesn't have business acumen, doesn't have a work ethic? I don't think so. Right? So therefore, you're looking for promoters with high integrity, high competence, and the translation of that integrity and competence is a high ROC business which generates surplus cash flows, and as Ashvin showed, reinvest those cash flows year after year to compound your and our wealth at 25, 30, 35%. That's tough to find in any country, in any walk of life. Whether you're playing cricket in the IPL, you're playing football in the EPL, you're playing tennis at the Australian Open, or you're investing in the Indian stock market, you're not going to find any more than 1% of any given population set operating at that level of excellence.
I'll give the other side of the argument. I think what Saurabh gave was the supply side, as in there are only so many companies and therefore you need to manage a portfolio of such companies. The other side is the demand side in terms of why do you need more companies? Right? Obviously, we've learned about diversification. Rather than putting all your eggs in one basket, the more baskets you spread your eggs, you spread your risk, you reduce your risk, which is right. But to what extent? Why not have 1,000 stocks? Right? Will a 1,000 stock portfolio be any less risky than a 10 stock portfolio? There has to be some science to it, which is something that my colleague Rakshit has articulated in one of the newsletters about an optimal diversification. The optimal diversification depends on the style of picking the stocks as well. If you've done deep dive research like Rakshit does, Saurabh does, Ashvin does, and therefore you've reduced the risk at the individual security itself, the number of stocks you need in a portfolio to diversify away the risk is that much less. If you are building a portfolio based on what your broker says, which is what a lot of people does, worse, if you're building a portfolio based on what your neighbor says in the elevator, you'll perhaps need 100 stocks to diversify that risk. So it all depends on the depth of research. If you've eliminated the risk around fraudulent promoters, risk around lack of entry barriers in businesses, risk around capital allocation, right at the security level, the individual stock level itself, you don't need more than 15 stocks to diversify the risk. In fact, what Rakshit has shown is the 16th stock actually doesn't reduce any incremental risk. It starts diluting your returns. Therefore, the 16th stock onwards, your risk-adjusted returns fall off dramatically.
Right. Thank you. And that's why I enjoy talking to Marcellus so much. So we've got a very interesting question from Mr. Archak here. Why have a fund for every market cap, CCP, Rising Giants, LCP, when you can have the entire 35 universe of stocks that you have, identified from this vast country? Any thoughts?
So look, I think one reason for that is liquidity. So the CCP stocks liquidity is no problem, as many of you know, right? HDFC Bank or a Nestle or a Pidilite, you can trade in and out. There's no problem, thankfully. The LCP stocks, the portfolio that Ashvin manages, he has to deal with liquidity painstakingly. I think we manage about 850 crores in it, Ashvin. 850 crores in it, and as many of you know, those of your LCP clients, they have compounded at 45%. We have a 3-year lockup. The lockup on LCP, I think, expires in summer of this year. But we had a 3-year lockup so that clients wouldn't come in and out, because if you try to come in and out of small cap stocks, it creates massive price impact. Getting these stocks, both whether you want to buy these stocks or sell these stocks, for example, a Moltec packaging, neither buying it nor selling it is easy, given the quantities in which Marcellus trades in. So therefore, a small cap portfolio, we necessarily have to have lockups. You can't just let people come in and go when they please. In a large cap portfolio like CCP, there's no need for lockups. Rising Giants is somewhere in between these two extremities on the liquidity spectrum, right? It doesn't need a 3-year lockup like LCP, but nor can we let people come in and go out of Rising Giants whenever they feel like. And therefore, the reason for bifurcating the portfolios on market cap lines is to align it with the liquidity availability in the stock market. If Moltec packaging was as liquid as HDFC Bank, we would create what the gentleman suggested, one all cap portfolio, right? We would probably call it Marcellus All Stars portfolio. Right. But unfortunately, Moltec packaging doesn't trade anything as light as HDFC Bank.
Right. And also to align it to client requirements, right? Some people might say that, look, I'm not bothered about taking small cap or mid cap risk when my return expectations are entirely fulfilled by consistent compounders whose risk is lower than that of a 10-year government bond. So if I'm fulfilling my return expectations and financial goals while being able to sleep so peacefully at night that my portfolio is extremely low risk, why even bother about small and mid cap? So rather than us forcing down small and mid cap down the throats of such people, we're giving the option. We're giving the option to people. You choose based on your return and risk expectations, which product is more suitable to you.
Right. Thank you, guys. So this question from Mr. Sagar, I have to take. So he has asked, economically, India has been a land of multiple mom and pop kind of stores. Big corporates coming in and taking in a lot of these functions like pathology or jewelry or maybe grocery tomorrow. Will that create an overall divide and disconnect in the country as a whole, and will in general lead to a more, unhappy population? What do you think, Saurabh?
I think we got lots of people in the audience who think quite deeply about these subjects. So look, every developing country goes through this. So I think, as the gentleman who's asked this question has very nicely inferred, when a country is very poor, the organized economy by definition will be chota sa. When a country is very poor, say India, turn of the century, we were a country with barely $500 per capita income. You obviously will have a very small organized sector. Most people will be running their own chota sa chai ki dukaan or chota sa PathLab. And then as you develop the country, when the whole definition of development, right, the whole definition of formalization means the cottage industry shrinks and the industry consolidates, right? So take an industry, for example, like our industry, asset management. There are 350 PMSs in the country, but you can look at the SEBI data on fund flows and see that 3 of us get 80% of the fund flows, right? Now, what will happen to the 347 PMSs which barely get any fund flows, right? It doesn't take a genius to figure out. But out of those 347 PMSs, many of them will say, this is simply not worth my while. Let me go to one of the top 3 or 4 PMSs and get a job there. And similarly in PathLabs, it's a $10 billion sector. $1.5 billion is in the hands of 4 or 5 national chains. And then there are thousands of mini PathLabs. Those guys will find it economically not viable to survive, and they will gradually wind up their operation and go and either sell out to a Dr. Lal, or they will go and get jobs in Dr. Lal. So I'll give you an example, and this is why it's not apocalyptic. This is the way the world works. I live in Powai, a suburb of Bombay. Near my house, there's a DMart. Another kilometer away is another DMart. Obviously, all of us are also using Amazon and we are using Flipkart. So the local Kirana store, Reliance General Stores, he packed it, he threw in the towel 6 months ago. So I asked him, "Kya hua?" He said, "Look, my son has got a job in a call center. A vada pav chain offered to rent my store. I did the maths. The rental I get from the vada pav store plus my son's salary at the call center is more than what I make from running the Kirana store. So the Kirana store is done. You shouldn't have a problem," he told me. यहाँ पे DMart है, वहाँ पे DMart है, घर में तो Amazon है ही आपके पास. So that's how formalization happens, right? And at a more glamorous level, those who run small businesses with say 20, 30, 40 crores turnover, many of them I'm sure are seeing that their sons and daughters have no intention of joining the family business. They want to work in London, New York, Bombay, wherever, and they are therefore either selling the business to a larger company, or they are winding up the business, selling the land to a real estate developer, taking out the working capital and giving the money to us to manage. This is development. This is formalization. this is something to be happy about, not something to get worried about.
Right. Thank you for that answer, and thank you for that question. I have not come across something such a question so far in a lot of webinars. Saurabh, we just will take a couple of questions more and try to conclude today's discussion. India as a cricket lover, India is a country that loves high strike rates. It loves batsmen who just play glamorously, and it has been for a very long time. So from time to time in your portfolio, a few certain stocks might not perform on the share price front, okay, and might not be a very glamorous share price to look at. Okay, a lot of questions have come across this particular aspect of investing. While this can be troublesome, but it is an important aspect of investing. Any one of you, what are your? How do you evaluate when share price is not doing anything for a while? Let's say 6 months,
So
1 year.
I request Ashwin to take this. Ashwin, if you could just take the audience to the lethargy framework again, and emphasize that the lethargy framework is how the longevity framework. I'm sorry, the longevity framework is how we assess stocks rather than the share price per se. The share price per se actually is of very little interest to us at many levels. If you don't mind, Sankalpo, I'll log off at this stage. Thank you very much for hosting me. Thank you very much.
Sure. Thank you, Saurabh. Thank you for being with us today. And
Thanks, Sankalpo.
Yeah. Sankalpo, do you mind?
Yeah.
The slide before that.
This?
Just one slide before this.
This slide?
Yeah. So, but I would start with making a general comment. Is that we are actually not looking at turnaround companies. So, as I talked about our investment process, you will notice that the emphasis is on finding companies with the relatively stable earnings growth. So consistent compounding companies with stable earnings growth. So as a result, we are not obsessed with companies which post losses in 1 or 2 years and bull market mo ekdam 100%, 200% growth, earnings growth. That is not our style. And through our investment process, that companies also doesn't get selected. So that is the one thing. And secondly, it may be possible that the company may not be delivering earnings growth for the next 1 or 2 quarters. But idea is that then we again once we invest into any companies in the portfolio, it is not that we forget about it. Basically, we constantly endeavor and continue doing research on that companies, continue meeting the management, continue to meet the people in the industry. And if the company is not delivering, earnings growth is not coming through, we try to get into depth of that. Is this is this a transitory in nature, or is it something structurally that has changed? Either the industry, either it may be also possible that we had some gap in our understanding about the promoter's competency or the competitive structure of the company. If the answer to that is after doing our research work that there is no structural change in our understanding or the business model of the company or the competitive structure in the industry, then we don't get obsessed about the share price, because we know that ultimately with a lag the share price is always reflected. And specifically to small and mid caps, in my experience of the last 3.5 years, the share price there is a non-linearity in the share price. So company may be delivering very good earnings growth quarter after quarter, but sometime the share price kind of doesn't reflect basically doesn't kind of move in tandem with the underlying earnings growth. But it may be possible एक हफ्ते में then as the market realizes there may be possibility एक हफ्ते में वो पूरा 50% return दे देता है. So you should expect that kind of thing in the small and mid cap space. You have to be a little bit more patient, in the small and mid cap space. But the underlying basic thing is that as a fund manager, as an analyst, we are very obsessed with the earnings growth. So I think once you remain convinced, you keep on tracking the earnings very closely, you remain convinced कि earnings growth आएगा, मतलब maybe 1 quarter there is a miss, 2 quarter there is a miss, but the company has in it that earnings growth will eventually come back. I think there is no need to worry actually.
Right. So thank you, Ashvin, for that answer. Thank you to the audience for joining in this call today. Before we conclude, let me just introduce, PMS AIF World. We are one of India's leading alternate-focused digital wealth management platform. You can know a lot more about the Rising Giants portfolio in detail and talk to us. I have shared the book a call link for with PMS AIF World. I'm posting it again. Please do book a call with us in case you want to understand more of these portfolios. For people watching us on YouTube, please like, share, and subscribe so that more videos like this come to your feed. Thank you, Ashvin, on behalf of the PMS AIF World team. I thank you and Marcellus team for being with us today. Hoping and looking forward for more such engaging discussions. Thank you, everyone.
Thank you. Thanks a lot. Thank you.